Welcome to the Win, Make, Give Well series. This is the remake, ladies and gentlemen. This is like, what's the second Top Gun movie?
Maverick.
This is like Maverick to the original Top Gun, which was pretty good.
They were both amazing.
Yeah. Ladies, you're hearing in the background the movie advice from Chad Himes. And silently, Bob Stewart over here, which does not appreciate Top Gun movies as much as
I'm saving all my energy right now because we're talking taxes, and I think sometimes people can get bored, glossed over, like I don't understand it. There's a lot going on. I rely on my tax professional. I feel like we got to bring a little bit of energy to shake people loose here today,
I just thought he was on vacation and not answering.
He's saving it up.
Where's Bob?
Yeah, where's Bob?
Okay, ladies and gentlemen, man, this has been Kinney. Of course, you already heard from Bob and Chad and Dave in the background. Hey, guys. And we are so excited to be at part 14 of the Well series. We are calling this one Pay Less Taxes. It's just like Pay Less Drugs, not to be confused with Pay Less for Drugs. Drugs are bad.
Yes.
Drugs are bad, ladies and gentlemen.
Like the store, Pay
I'm
Less
glad he
Drug Store.
clarified that,
Got it.
yes.
Sorry.
Payless shoes, right?
Oh,
Yes.
Payless Shoes. I forgot about them.
There you go. We are not sponsored by anybody, yet if they want to send us money or free product, we will accept it.
Except for any money you send is not for tax advice,
Yes.
investment advice, or
No.
anything that we are not licensed or expert to give.
Probably why we give this thing away for free.
That
Just
is
in
why
case, right?
The Well series has zero advertising and no cost.
Yes.
You get what you pay for, people. You get what you pay for.
All right.
Okay.
All right. Here we go.
This is a subject that it means a lot to me. And Robert Kiyosaki, who author Rich Dad, Poor Dad, and Cash Flow Quadrants, a lot of things, he says taxes are your largest single expense. Not today or this year, but in your life, Bob. It's your largest single expense. I want to read a little part of a book that was life-changing for me. And it was Tax-Free Wealth by Tom Wheelwright, who all of you will hear from in the next session here
Stop
in the
giving
Well
things
series.
away, Ben Kinney.
Sorry. Chapter 1, taxes are stealing your money, your time, and your future. Let me just read in my best late night love music, smooth jazz voice.
Dave, insert some soul music underneath here, please.
Okay. Every day, taxes are stealing your life away. Income tax, sales tax, value-added tax, employment tax, and a host of other taxes are eating away at your life. You may think they are just taking your money. If only this was all they were taking. Taxes don't just take your money. They steal your time, because money is time. People with lots of money have lots of time because they don't have to spend their life trading their time for money. Instead, they trade their money for time. Mm-hmm. The average person in a developed country spends 25 to 35% of their life working to pay taxes. You guys hear that?
Ouch.
Not 25 to 35% of their income, 25 to 35% of their life is spent working to pay taxes. That means that more than 2 hours of every workday are dedicated to feeding the government. And the government, ladies and gentlemen, off script, is hungry.
I was going to say, likes to eat.
They're like the hungry hippos.
Oh, nice.
Right? And 3 to 4 months out of every year are spent working solely so that you can pay your taxes. Mm. That adds up to over 13 years of your work life and 20 years of your lifetime. That's a prison sentence, Tom says. And it's not going to get better anytime soon. As inflation eats away at your spending power of our currency, it also puts us into higher tax brackets. So we end up with even less purchasing power because a higher percentage of our income is taxed. And with the increase in the number of entitlement programs in every country, there's a higher demand for tax revenues to support them. The United States alone has over 80 trillion of unfunded social liabilities in the form of Medicare and Social Security promises to its aging population. And this number grows every day as new entitlement programs are enacted. I'm going to skip a couple pages. Here's something that really kind of shook me to my boots when I first read this book, gentlemen. People think that you really have no choice on how much tax you pay. Everyone has to pay taxes, right? Wrong. There are millions of people who legally pay little or no tax. What's their secret? Do they know about loopholes that are in the law that allow them to get away with not paying taxes? Nope. They simply understand how the tax law works. They understand that the tax law is not something the government uses to raise taxes. The tax law is a tool the government uses to shape the economy, promote social, agricultural, and energy policies. These people who pay little to no taxes, gentlemen, understand that the tax law in every developed country is now a series of incentives for entrepreneurs and investors. In the United States, over 95% of the tax code
This is amazing.
is intended not to raise taxes, but rather to stimulate economic, agricultural, and energy activities. In fact, the tax law itself, the books stacked upon themselves, right, is a map or a code to massive amounts of wealth. And the tax code doesn't only show you how to reduce your taxes. If you follow the tax law carefully, you will discover that the secrets to amassing huge amounts of cash flow and wealth are found within its pages. The tax law is a map, let's just reiterate, to vast amounts of wealth. And the tax code doesn't only show you how to reduce your taxes. If you follow the tax code carefully, you will discover that it's the secret to amassing huge amounts of wealth. As you go back in the other lessons that we talked about, investing in real estate and financial instruments and businesses and compound interest and all the things that we talked about, Chad.
Yep.
We all wish we had a little bit more money to do a little bit more of those things.
Yes.
Well, maybe that money is not only found in making more money, but maybe it's just found in a tax strategy that's a little bit different. Here's the reason. The reason is quite simple. The government wants the economy to grow. It wants you to invest in local energy, especially clean energy.
Okay.
It wants you to invest in agriculture,
Makes sense.
food, farms, right? And it wants you to invest in economic activities that create housing and jobs
Of course.
for our community. All of this is contained within the tax law. Now, there's one last little piece.
Basically, what you're saying as you're reading and you're finding this last piece is if you know, right? When it comes to the tax rules, how many people are up in arms over people who don't pay taxes? And it's really not that they're not paying taxes. It's they just know.
Tom wrote in Tax-Free Wealth, the
Yep.
key points to chapter 1. He said, become one of the wealthy and stop giving the IRS your time. Learn to trade your money for time and engage in activities the government uses to shape the economy. Remember, the tax law is a series of incentives for entrepreneurs and investors. Taxes are based on your facts and your circumstances. To change your tax, you got to change your facts. What you know and what you learn and how you understand is going to make a big difference. When Tom wrote a second book, Win-Win Wealth Strategies, Bob Stewart, he said, I'm going to teach you how to partner with the government. Now, I sat down with a friend and she said, my husband and we fight about this all the time because he feels like it's our duty to pay taxes. And in many ways, I agree. It's our duty to contribute back to the world, to the countries we live in, and to do good. But we can either do it by giving them money and let them decide how to spend it,
Yeah.
or we can decide where we want to put our money
Yep.
and get that tax benefit.
Yep.
It's like the difference between giving to a nonprofit. If I said, hey guys, you got to give 10% of your income every year to a nonprofit, I would assume that you guys wouldn't just give me your 10% of your income and allow me to decide to save owls or whales or to do something. You would probably decide something that meant something to you,
Right.
right?
Yep.
That's the difference. Do you want to just blindly give to charity and end up giving to a cause you don't care about? Or would you like to decide what charity you give to?
You just right there, Ben, you've just completely changed my whole look on taxes. Right? It's not that we're not paying the money that we should be giving back. It's are we just going to give it to the government and let them decide where it goes, or are we going to decide where we want to take advantage of these opportunities to put the money ourselves?
I pay a lot less taxes as a percentage of my income today as I ever have in my life.
Wow.
And yet, Chad, I do more good today than I think I ever have. I do more to help homelessness. I do more to help the hungry. I do more to help schools and
'Cause it's your
children.
choice.
And I create more jobs and I improve the community and I help save the environment.
Yeah, I want to circle back to something, but Bob has
Well,
something.
we
he wants
see
to
this.
say.
This comes up every once in a while, right? Like Trump is maybe, but like Bezos is another one where I don't know when it was. Jeff Bezos not paying any taxes, but the reality is, like, what that guy does with his money is exactly what the government wants us to do with our money, which is go out and create jobs and fund philanthropy and all these different things. So, like, it's not that Bezos created Amazon, and if you're up here in Washington where we're at, they're paying lots of taxes on lots of the employees are paying taxes. They're out buying stuff. They're paying sales taxes. Like, because he didn't pay taxes for a few years as he was building this massive thing, right? But it was for the good of the communities that he was building those things in. So,
Right.
We will find out, over time, history uncovers all. We'll find out who was doing tax scams,
Right.
and who was following the rules.
Who's
Now,
playing by the rules? Okay, so let me circle back to something because you gave a great line, and I'm really, really surprised. Because look, we're not just here to help everybody.
he's surprised I gave a great line.
No,
Is that what he said?
no. You'll see where the
That's what I
surprise
heard.
comes. Because I consider us like entertainers, right?
Yeah.
And you have this habit of breaking out into rap every now and then and singing for us. And you gave a perfect line from Tom there that said, if you want to change your tax, you have to change your facts. And I can't believe, Ben, for the sake of our audience, you didn't just all of a sudden bust that out into some sort of rap session.
I might.
I mean, I'm a little disappointed at the moment.
I'm not going to lie. Like, I am disappointed too.
So we're going to expect before the episode's over, you to wrap us out with that line, maybe.
Yeah, that's how we're closing this one.
I might crack a
All
rack later if I need to. Okay. So at winmakegive.com/wealth,
Yep.
you can register. And if you're registered, you will get emailed and texted a link to download the workbook.
Yes.
If for some reason that didn't happen,
Yep.
you're going to go to our Facebook group, which is,
Win, make, give.
okay, and you're going to join the Facebook group.
Yep.
Because every time we launch this episode, we also put it in the group.
I'm putting it there. I'm pinning it to favorites. And Ben, I'm hashtag wealth2. So they can either go look in the favorites, they can search the hashtag wealth2, they will find the link. And just a little side fact, if you didn't know, the hashtag, the tic-tac-toe sign, the pound sign, it is actually called an octothorpe. Just a little side bit for our audience.
Okay. This is a particularly important one because this episode, this part of the Wealth series, has some extra math.
Oh, good.
And it's a little confusing.
Bob,
so
you ready?
we've created
I'm
some
ready.
worksheets that you can walk through and fill in the blank.
Yep.
And we've also got some tables that you need to access if you're going to do the math.
Yeah, this is like the compound interest section where we had tables and we gave you the math. So make sure you go get the workbook to go through this, because if you're listening to this now, you're going to want to re-listen to it again with the workbook in front of you.
Maybe we'll make a little simple spreadsheet that you can download and put in your income and put in your deductions, and it'll automatically fill in the tax bracket. I don't know if we can get that done in time, but maybe when you go to the resources, you'll see that. We'll see how it works. Let's start by jumping into the different factors that affect how much you pay in taxes. Your taxes are based on a term called your taxable income.
Okay.
This taxable income is the amount of income that you tell the government that you make after all deductions. And there's lots of deductions.
Yes.
So you have your gross income.
Yep.
And then you deduct all the things you're able to deduct.
Yep.
And then what you're left with is your taxable income. And your taxable income is what you're going to use the tables in the workbook to calculate how much money you'd pay in taxes if you were single or if you were filing as a couple or married jointly, and based on what income you make, all these other considerations.
So Ben, I want to be clear for our audience's sake. This isn't your gross income. you make $100,000. If that's what you're estimating you're making in 2023 for the sake of these exercises, because we're going to ask you to estimate what you're making this year so you can be looking ahead. You're saying after this episode, we're going to show them ways to maybe reduce that gross income. Plus, we've talked about some of the financial instruments where they can be making deposits that will then reduce their taxable income, and they're going to be left with a taxable income number. That's the number they should be working with today as they're going through this worksheet in front of them.
Yeah. And if you don't have it, just guess and do the exercises anyway.
Yep.
We're going to walk through a couple of examples, and Bob's going to lead us through this.
Thank you.
And we're going to figure out, based on certain incomes, one single, one married, so on, what you actually pay in taxes.
Okay.
When you're done with that, you're going to get an amount that you paid at taxes, and that amount is the money you write a check for to the IRS, or that you prepay out of your paycheck every couple of weeks, and if you overpay, you get some back in what's called a tax refund.
Right.
Everybody follow me?
I'm with you on this so far.
Okay.
And if I can stay with it, everybody else can, because that's my role here.
When you're done figuring out how much money that you paid to the IRS, you can take that amount, let's say it's $20,000,
Okay.
and you could divide it by the amount that you made, your gross income.
Okay.
And you could come up with your effective tax rate. So if you made $100,000 and you paid $20,000 taxes, your effective tax rate is 20%.
Right.
You effectively gave up 20% of your income for taxes.
Okay.
Follow me?
Yep. Absolutely.
Okay. When you go into the worksheet or any of the links that we give you, you're going to see these tax tables. And the first tax table that I want you to look at is the let's do the 2023. The 2023 single and ready to mingle filers tax bracket.
Now, the singles not ready to mingles, you still have to use the same tax bracket.
Same tax bracket.
Sorry.
Yeah.
Yeah. Okay.
So if you made not over $11,000,
Yep.
it's really simple. It's just 10% of whatever you made, you owe in taxes.
Okay.
So if you made $8,000,
10%.
you're going to pay $800 in taxes.
Got it.
However, if you made over 11,000, but not over 44,725,
Yep.
you're going to pay $1,100.
Which is what you would have paid on that $11,000 at 10%.
Yeah, it's 10% of 11,000.
Yep.
Plus, you're going to pay 12% of everything above 11,000
Got it.
up to 44,725.
So this is those tax brackets we all hear about that nobody really can ever explain and understand. You're showing us on this chart, Ben, 11,000 to 44,725, 44,725 to 95,370. These are the brackets, and we're taxed the different income amount in each of these brackets.
Yeah, for instance, let's say we made 44,000.
Okay.
We would be in the 12% tax bracket.
Right.
But when you blended it, knowing that you only paid 10% for the first 11,000,
Yep.
and then you paid 12% for everything after, you could do the math and figure out what was your effective tax rate.
Got it.
Let's go back to the tax chart,
Okay.
and let's say that we made 150,000,
Okay.
and we're filing as a single person.
Yep.
We would be in the 24% tax bracket.
Got
Because
it.
as you see in the chart, it says anything over 95,375,
Yep.
but not over 182,100, you're going to pay 24% of everything over 95, but under 182.
Yep.
Plus, you're going to pay 16,290.
Right. And what you're saying is when I do the math and add it all up, it's not actually the 24% tax bracket. My actual, depending where I am in there, is going to be slightly off from that number.
Yeah.
Okay.
Now, if you're married, let's just go down to the married chart.
Which you'll see in your workbook. Just look down.
Yeah. And it'll be married filed jointly. You're filing your incomes together. You're not filing two separate tax returns.
Correct. That's me and my wife. Yep.
It says everything up to 22,000, you only pay 10%. And when we were doing single by ourselves, it was everything up to 11,000, Chad, you pay 10%, and everything above 11,000, you paid whatever the right bracket was. Follow me?
Yep.
So in that same example, you would look at this chart and say, where does my income fall when I combined my spouse or my partner's income with mine, where would I land? You're going to figure out where your tax bracket is.
Okay.
And part of the workbook homework is you're going to go figure out, based on your income goals for 2023,
Yep.
if you had no write-offs,
Yep.
right, how much are you going to pay?
Okay.
And we give you that exercise in the workbook.
Okay.
Now, if you're a kid, I want you to understand how much of the money your parents make, they don't get to keep. How much they have to give to the IRS. In fact, parents, from now on, when you're paying your kids their
allowance or chores
allowance,
or,
I think you should withdraw a fair amount of taxes from it that maybe you make them invest.
10%, right? Because
At
they'd
least.
probably be in that 10%.
Wait, all these kids on here just went from loving Ben Kinney to like, wait, what? Huh?
Well,
Ask for a
Crush
raise,
us for
kids.
16%.
Well, notice I didn't want them to pay it in taxes. I wanted them to put it in an investment account or a
right.
savings
The
account.
parents
or
should
something.
tax the kids, but
I
they
think
should
so.
invest that money so the kids can learn.
Sorry, kids. I apologize in advance,
Okay.
but that's fair.
Ben, look, you've explained these tax brackets great. I'm the kind of guy, though, who kind of understands going through it, and Bob's our math guy. Can you throw some numbers at Bob maybe and let Bob walk us through the math on a few of these examples to help the audience?
Yeah, Bob, what I want to do first, and everybody, you're going to follow through in the workbook. You're going to fill this out with us so you understand it. It's the only way to learn this and not be confused is the follow through. Bob, the first thing we're going to do is we're going to do a single filer.
Okay.
And that person makes $80,000 in a year.
Got it.
Okay.
So as I understand, the first thing they would do is they would go to the tax charts that we provide, and they would figure out where does 80,000 land.
Oh.
Now walk us through what they would do from this point forward.
All right, so if you pulled up, I'm a single filer, the 2023 single filer tax bracket you'll see on your worksheet. I'm going to find that 80,000, and it falls in that 22% bracket between 44,725 and 95,375. 80,000's in there. So what I'm going to do at that point is essentially I've paid tax on everything up to 44,725 at either 10 or 12%, right? And that's going to be a total of $5,147. Then what I need to figure out is, okay, how much have I made over the 44,725? That's the starting point of that bracket. So I'm going to take $80,000 and I'm going to subtract 44,725. And that's going to leave me with 35,275. Now that 35,000.
Wait, slow down for me, Bob.
Okay.
Bob,
Okay.
you got to slow your roll, man.
Yeah, there
Okay.
you go. We'll have to
Okay,
rickroll
80,000 was how much I said I made.
80,000 is how much you made. That
I'm going to
bracket,
subtract from it
Yep, the 44,725.
725 because it says on there that we're going to pay.
22%.
of the excess over the 44,725.
So when I subtract 44,725 from 80,000, Bob, what do I end up with?
35,275.
35,275. And I'm going to take that 35,275 and multiply it by what?
0.22 or 22%.
Because why?
Because I'm paying a 22% rate of tax on the money in that bracket that I made over 44,725, which is $35,275.
So when I take 35,275 and multiply it by 0.22,
Yep. I get $7,760.50.
$7,760.
$60.50.
And is that the amount of money I have to pay in taxes?
No, because I
Because-
still had that money that I paid on the first 44,725, and
So I
that
have to-
amount was 5,147,
So
and
I have
that's
to
on
add
the spreadsheet.
5,147
Got it.
to 77,6050,
Yep. you
which
got it.
means I am paying how much in taxes?
$12,907.50.
So if you make 80,000 a year and you say, gosh, I make 80,000 a year and I feel like I should be in a good situation, you're not really making 80,000 a year because you're making 80,000 a year minus 12,907.
Yep.
And that doesn't include Medicare,
Yeah. State
Whatever.
income tax if you have state income,
income
tax,
tax,
sales taxes that you're paying on
L&I,
goods.
whatever, right?
Yeah.
That's on top of that. That's a lot, Bob. And we already saw what $12,907 invested every year for a long period of time. It equals a lot of money.
Yes, it does.
Millions and millions. Okay, that is effectively what tax rate? Did we figure that out?
Yeah, it's a 16.13% tax rate.
So we took 12,000 907, and we divided it by the 80,000 total income,
Yep.
and it equals what percent?
16.13%.
So this
16%.
person making 80,000 with no tax deductions is effectively giving up 16.1% of their income, just the federal income tax, before state income tax, Medicare, L&I, health insurance, anything else they pay. That's a lot.
Wow.
That's a lot.
Yeah. Like if they worked a 6-day-a-week job, that's one of those 6 days, basically, they're just
Yeah.
giving it away for.
Okay, so now you fill that out in the worksheet and you're following along.
Yep.
I don't care if you're confused, just fill in the blanks. It'll make more sense as we go forward. Bob,
Correct.
let's pretend that the next person we're helping with on their taxes is they're married,
Okay.
Filing jointly, Ben?
filing together jointly.
Okay.
And let's say combined, we'll pretend this is Chad for a second.
Yay.
Let's say combined.
Oh, wait a minute.
Chad and Nita filing jointly
How'd we do?
made 210,000.
Sure.
Not too shabby.
Sure. We'll work that number.
Yeah, 210,000 in an income that you're going to report to the IRS.
Yes.
Okay, Bob, tell us what we're going to do step by step.
All right,
Did anybody
so-
else just feel game show moment there? Bob, tell him what he's won.
All right, so here we go. So we're gonna look on that bracket. We're gonna
Wait, wait,
figure
wait.
out where does 210,000 fall, and it falls
Which bracket?
on the 2023 married filing jointly tax bracket.
Okay,
I'm having
we're-
too much.
I'm looking at the thing right now, and then how far down am I going to go?
So I'm going to go down to the fourth section down there, the one that's over 190,750, but not over 364,200 because I'm at 210. I'm right in that fourth bracket down.
Okay, so
Got it.
in our worksheet, we're going to write annual income of married couple 210,000, and then Bob, walk me through the next step.
All right. So in this, as you look there, it's basically I'm going to pay 24% on the excess over the tops or the bottom side of that bracket, 197.50. So I'm like, all right, I got 210,000.
Yep.
I'm going to subtract 197.50 to figure out how much tax I'm going to pay in that 24% bracket, which is 19,250
Okay, so we have 19,250
times 24%,
times 0.24,
which is going to give us 4,620.
4,620. So is that the total amount of money we pay in taxes?
Nope, because I got to pay taxes on all that money from the 190 previous, right? Where some of it I was paying at 22%, some at 12, and that first 22,000 at 10%. So that total was 32,580 on everything that I got taxed on up to 190,750, and then that 4,620 that was left, Ben, that we got taxed on at the 24% rate, we're going to add to the 32,580 for a total of $37,200 in taxes.
Meow.
So 37,200.
Yep.
A married couple
Yep.
filing jointly is going to give to the government if they don't take advantage of any strategies
Right.
that they are going to give to the government out of their 210,000, which Bob means their effective tax rate
It's 17.7%.
So for every $100 they make, they give $17.74 away to the government, not including state income tax, Medicare, L&I, business tax, sales tax, gas tax, any other tax,
Property tax. on
thumb
and
tax.
on.
I am not paying my thumb tax this year.
All right, fine.
Now, just out of curiosity, Chad,
Yes.
since we're using the you and Nita generic example,
Sure.
make believe, if you had an extra 37,200 a year and you were taking the wealth series, what could you do with that?
Well, I'd probably be putting a down payment on an investment property, Ben.
Probably buying another house.
Or I might be looking at some business opportunity that's out there that
Starting
needs
a
a cash
business.
influx, right?
Yeah.
Or I'm going to take, and I'd have to go back and pull the numbers up. I'm going to put a chunk of it into an IRA so I
Yep.
can start putting some of that money aside. But
Or a 401k.
right, 401k,
Or HSA.
all of them, a little bit of each of them, right? There's going to be plenty of things I'm going to be able to do with this money thanks to the lessons that we've learned over the last few episodes alone.
Whoa. Okay. We've done two examples. We've done somebody single.
Do a big one. Give me a
ready
big
to-
one.
Ready to mingle.
Okay.
Patience, Daniel's son.
Ah,
Who paid $12,907. We did a married couple, Chad and Nita.
yay.
And then we're gonna do. My dad said it's just as easy to fall in love with a rich girl as it is a poor one.
Yes.
We're gonna do the rich girl.
The wisdom of Mike Kinney. I love it.
Who in this situation, let's say the rich girl is married.
Okay.
And she's making $900,000 and her partner is making $100,000. So combined, Bob, they're making $1 million a year.
Okay.
Okay. Just to illustrate this in the millionaire range.
Yep.
Bob, walk us through step by step. What table do they go to? And what would they pay? And let's figure it out. And then while Bob is doing that for a married person, Chad,
Yes.
we just go and do the math on if the person was single and ready to mingle, what their total tax would be. You don't have to walk us through all the steps. But
The
just give us
900, or she was making $1 million still on her own?
$1 million total.
Okay.
She'd make way more because she didn't have a husband or boyfriend.
She'd
She'd
have to
work
spend that
more.
time
She'd
with
have to
family.
waste all
Sure,
that
yeah,
time
okay, right.
Totally.
Got it.
doing that kind of stuff. Okay.
All right, so here we go. So we're going to be in the 2023 married filing jointly tax bracket. And we're going to go all the way down to the bottom. It's the 2, 4, 6, 7th one down, the 7th bracket.
This is the highest bracket, Bob.
highest bracket,
Which
37%.
We would call the 37% bracket.
Yep. Well, we're not going to pay 37% on all $1 million. We just know it was 370, right? Because
Yeah.
there's all these brackets along the way that we're going to pay lower rates in. So what we're going to do is we're going to figure out what's the excess above $693,750.
Now, I don't know if there's anybody from the IRS listening, but I don't think anybody of us would care if you rounded up to a freaking even number. Like, do we need the 200, the 450, and the 7? Let's just round up, please.
Yes, that would be smarter.
But in today's situation, it's not. It's 693,750, which
is
they
weird,
would
yeah.
subtract from what, Bob?
From $1 million. And
Okay.
they would be paying that 37% tax bracket on $306,250 of that income.
306,000.
$250. 37% of that, which would be $113,312.50.
Which is not the total amount they pay in taxes, because they also have to pay everything that they should have paid up to 693. Which,
got it. So
just to clarify, everybody, that would be 10% of everything up to 22,000, and 12% on everything up to 89,000, and 22% on everything up to 190, and 24% on everything else for. We get the point.
Up we go. Yep.
Okay,
so that total of everything
Wait,
that I
wait,
would have
wait.
paid up to $693,750 would have been $186,601.50.
601.50, and that they would add those two together.
Yep. Added to the 113 for a total of $299,914.
That's what they would have paid total, Bob?
$299,914, which is an effective tax rate of 29.9%.
Okay.
Oh.
I just want to stop here for a second, because the media, the news, and people out there that don't understand this, they say the rich need to pay their fair share. Well, we looked at somebody that was making 80,000. What was their effective tax rate?
16.13.
Okay. And when we looked at the married person paying 210, what was their effective tax rate?
17.7.
And when we looked at the person making $1 million, what is their effective tax rate?
29.9. I mean, yeah.
It gets worse.
The more you make, the more they tax you.
Let me ask you a question. Are people making more money paying more as an effective tax rate than?
Absolutely.
I got a big takeaway for you over here, Ben.
Please.
Get married.
There you go.
And I'm going to tell you, because I ran the numbers. You asked me to run the numbers. So while Bob was running the numbers for this married couple that made $1 million,
Okay, we're looking at a single girl.
I went a single person making $1 million.
Okay, and what did that person pay in taxes?
They paid $330,332, which is effectively a 33% tax rate, and a difference of $30,418 more by being single.
Young lady making $1 million. It's cheaper to keep him.
Yep.
It's cheaper to keep him.
He's worth $30,000,
Yeah, maybe.
$418.
Maybe. You got to ask the question: is he worth $30,000 or not? Maybe. He might be. You never know.
The biggest takeaway of the Well series: it might be worth to keep him just because of the tax benefit.
Okay. Now, I've had you guys do this exercise in explaining tax law to everybody.
Yes.
In the workbook, we have written out a variety of tax deductions that you could do in detail. I'm going to
Yes.
give you a couple examples. One, you could hire your children. If you own a business,
I wish I knew this way back. I really do.
by the way, in the business section of the Well series, which we've already covered, we talked about one of the benefits of owning a business is that you can write off things that you couldn't write off if you just had a job.
Correct.
And you can hire people that you couldn't hire if you didn't own your own company. In this situation, you can actually hire your children.
Remember, seek out personal or professional tax advice. Thank you.
Yeah, instead of giving you tax advice, I'm going to give you an example.
There you go.
My friend Brian, who's been on the When Make Give
Yep.
podcast, he has 2 daughters. And he pays them a fixed amount of money every year as an employee because he owns his own business. And as an employee, he also makes them do actual work.
Of course.
And there's something called the standard deduction. And we didn't really talk about it in the previous examples, but let me give you what that is right now. Right now for all
I'm
of
just
you.
realizing why my dad put me to work when I was like 9 and 10 years old. He was just saying, while you're sitting there watching that on TV, do this. And he was made an employee out of me without me realizing it so he could write me off.
Indeed. So here's the situation. The standard deduction for 2023 is $13,850.
That's what each kid's worth?
That's what any one of us could make and pay no tax.
Okay.
So in the examples we gave you prior, remember we said that was their taxable income.
Right.
Their taxable income is after standard deductions or any other deductions.
Okay.
So like the $11,000 example would actually be $24,850.
Yeah.
Does that make sense?
Yeah.
It means that you could literally pay your children $13,850 a year.
Yep.
Take that salary as an expense to your business,
Yes.
and they wouldn't have to pay any income tax on that because they're exempt up to $13,850. Now, when Brian does this, he pays them on payroll, just like anybody else,
Sure.
but he deposits it in the kid's account, and they actually have a debit card and so on. And when they take their trips for dance, or when they got to pay for their memberships for sports, or when they do their things, or when they want to go out clothes shopping, etc., he makes them pay.
Sure. Great
Also,
lesson.
he makes them contribute the first $6,500 to the IRA.
So he's got kids that have already started investing and they're going to have that 50-year timeline we've talked about.
And if you come to one of our events, Brian and I run a little business called Metrics Masterminds.
Yep.
If you come to one of our events, you'll see the girls are there working, handing out, getting signatures. They even present from time to time. They're in our marketing materials. They actually do work for the $13,850 or whatever Brian pays them per year.
Right.
So one of the tax strategies that I want you to think about is if you own your own business, maybe you could hire your children. If you're a grandparent and you're looking for deductions, you could hire your children. But remember, the money actually has to go to them, Bob.
Yeah.
And they actually have to do something in return.
Yes.
Okay. There's lots of other strategies out there. In the real estate investing section of the Well series,
Yes.
we talked about the benefits of home ownership.
Yes.
And we talked about some of the tax strategies of owning real estate. There's as your primary residence, you can deduct your interest,
Yep.
your property taxes, up to I think $750 or $1 million home. You can subtract any points you paid for financing when you purchased a home and you got a mortgage that year. There's lots of deductions when you have an investment property. There's things called depreciation. There's more advanced strategies called accelerated depreciation or cost segregation. There are 1031 exchanges. There is conservation easements on real estate. There's lots of different strategies, some of which we'll talk about in the next tax call that we're doing right after series after this one.
Yep.
You're going to learn about. But there's lots of tax benefits in real estate. We talked about in owning a business, some of the tax benefits of owning a business, like being able to write off your home office
Yep.
or your internet service.
Correct.
or your vehicle or anything else that your cell phone, anything else that you use.
Yep.
There's lots of benefits. Like even when we talked about retirement accounts, the ability to fund your own retirement and match it if you're own your own business.
Yep. Meals while you're having business meetings, and we talked about a lot of that stuff in that section.
Speaking of which, we should take a break and get a meal soon.
Oh,
because
awesome.
we're hungry.
All right.
Retirement accounts. And we talked about some of the retirement account maximum contributions that you can give in the financial instruments section of how much you can put to an IRA, a 401k, and so on. There are lots of advanced tax strategies that we're going to talk about in the next part 2 of Pay Less Taxes, which you're going to hear in a couple days. But I want to kind of bring this all together, Bob, in an exercise that I haven't told you about.
All right.
Oh,
But we're going to do together.
On the fly, Bob Stewart.
Here we go.
There's lots of crazy tax loopholes. Like in North Carolina, I think you can donate a certain amount of deer meat every year and take that as a tax deduction. So
I was reading the other day, you could write off your pets, the expenses for your pets if like your cat was a pest control at your office, right? Or your dog was a guard dog. Like there's
that's funny. My
Never
dog doesn't guard anything. Here's one.
Yep.
If you buy a vehicle over 6,000 pounds, right now you can write off 100% of the purchase price in year 1. I don't know if the tax laws change right now. Maybe we'll ask Tom that. But as of last year, you could. But it had to be over 6,000 pounds. So if you owned a business and you wanted to write off a vehicle, you might ask yourself the question, is it worth it for me to buy an over 6,000 pound vehicle? Like my Ford 150, over 6,000 pounds.
Yep. Had to get a new one. Made sure it was big enough.
SUV?
Truck.
Yeah. Nice. I like it. Okay. There are a variety of things that we've already talked about that you can use to reduce your taxable income. So Bob Stewart, we're going to start with a single person making $100,000.
Okay.
Tell me on the worksheet, what would they pay in taxes if they had no deductions?
a single person making $100,000 would be 2023 single filer. So they would be paying a little bit on that excess up over 95,375. So 100,000 minus 95,375, 95.
Hum the Jeopardy theme while you're doing the math?
$4,625 that we would pay at a rate of 24% times 0.24 would be 1,110, and we would add that to 16,290. So plus
27.
16,290 would be 17,400.
17,400, or effectively 17% of their total income.
Yep.
Now, we talked about the standard deduction of 13,000 whatever.
Yep.
So actually in this situation, we're talking about reported taxable income. So this person would actually be making 113,850 in this example.
Right, because you said it was tax on the 100,000.
Yes,
Right.
tax on the taxable income's 100,000 after their standard deduction.
Got it.
Okay. But Bob, this particular person is going to put 22,500 into their 401k. They're going to max it out.
Okay.
So we would take 100,000 and we would subtract 22,500 because they're putting it into their 401k.
Yep.
Next,
That's pre-tax, so they're going to deduct that money,
Yep.
as you taught us earlier. So it's going to come off that $100,000.
So if we stop there, they would tell the IRS not that they made 100,000,
Right.
but they made it 87,500.
Not that they made 113 or 100. That they made.
77,500.
Yeah, whatever that math is. Okay.
That's why
Next.
you're here, Bob, not us.
Next, Bob, they're going to buy a car.
Okay.
And that, because they own their own business, they have a little small business, right? Maybe they
Mom, pop,
sell
whatever.
Amway, or like, it actually doesn't matter. Like MLM, they got their real estate license. It doesn't matter as long as they own their own business.
Yep.
Right. And they're going to buy a car.
Okay.
Now, what did your car cost?
40 plus.
Okay, but they're not going to buy that expensive a car. Let's say, but they're going to buy a $30,000 truck. They're going to trade in one of their other vehicles, Bob, and they're going to, but at the end of the day, they bought a $30,000 truck.
Yep.
Since it's over 6,000 pounds, they can write off the entire amount.
Yep.
Of 30,000.
Bob, another 30,000 off that, please.
They're paying payments on it.
47,500.
So it's not like they had to come up with 30,000. They traded in a vehicle and they're paying a couple $100 a month for their car. Follow me?
Yep. I sure do.
Okay. Also, Bob, they maxed out their HSA account. And since this is a single person, they can put $3,650 into an HSA. So everybody, inside the Well Series workbook, there's this example. You're filling this in. You're following along with us. First one, $22,500, 401k.
Yep.
Next one, car deduction for over 6,000 pounds.
We're saying it was $30,000 for the car.
Yep. And then HSA, they maxed it out at $3,650.
Hey, Bob, I feel like I'm on like the reverse, telethon.
So right now
or something.
we're telling the government we made 43,850.
So instead of the 113,000 we made before the standard deduction, where we told them $100,000, now with these things, Ben, you've already got them down to telling the government they only made 40 whatever thousand it was. Bob just said
43,850.
Now, there's one other thing that I'm going to add.
Okay.
Because I think one of the greatest differentiators of wealth in America.
These how words work?
Is home ownership.
Yes, of course.
And this person found a home to buy for $300,000.
Sure.
And they did a 0 down, or they did a FHA 3.5% down. They have a couple of roommates. It doesn't matter. They found a way to buy a $300,000 house.
Okay.
And I just figured out that the amount of interest they would pay, assuming they had a loan for $300,000, I'm just trying to simplify this.
Yep.
Was $17,400. And since
year?
it's your primary residence, for the total year, you could subtract 100% of your interest paid.
Okay. So that's
Also,
what they're paying in the first year, in this year that you're doing this math.
First full 12 months. They could have bought the house last year or whatever it was.
Sure, but we're just for easy sake, we're not worrying about the amortization charts and all that, folks.
That's interest.
Right.
They don't get to write off the principal, but they do get to write off the interest.
Right.
They also get to write off their taxes. So I just took an average taxes for a $300,000 home in America, and it was about $3,360.
Okay. Bob, another $3,360.
Yep.
Now, Bob, when you add all of those things up, these are called tax deductions.
Yep.
They reduce the taxable income from $100,000 all the way down to what?
$23,090.
So now the $23,090 is their new taxable income, which they have to pay taxes on. So Bob, help me out in figuring out, how do I calculate how much somebody would pay in taxes? Remember, we're looking at the single filer, second one down, because it was over.
It was over 11. It was 23,090. So if I'm in that 2023 single filer tax bracket, I'm going to be looking in that second bracket down, which is between 11,000 and 44,725.
It says $1,100 plus 12% of everything over 11,000. So 12% of everything over is what?
Well, 12. So everything over is 12,090, which I multiply by 0.12 to give me $1,450.80 that I then add $1,100 to. So I basically am going to pay $2,550.80 in taxes.
I'm not super good at math, but is $2,550 a lot better than paying $17,400?
Yes, you are correct, Ben.
You went from a 17.4% effective tax bracket to now
2.5%.
2.5%.
Yeah.
Now you can get mad at rich people paying less taxes, or you can find a way to invest in what the government wants you to invest. Now, I didn't even include the money that we gave to church on Sunday.
Right.
I didn't come up with the home office deduction or any of the other things that are out there. We
just simplified this example. We were making it up as we went, folks, as you can tell.
If you read the tax-free wealth and the win-win wealth strategies, and you took some more of our lessons, that you would go from giving $17,400 to the government to only giving $2,500.
So what's the difference there, Bob? I mean, math in my head is 15, right? Okay.
14 and change, or 14.
What are you going to do with that $15,000?
Well, some people will be like, I don't feel like I could give $22,000 to my 401k. But in this example, you kind of just found all the money you needed to max out your retirement.
Yeah, because the $15,000, you saved $15,000 to give that $22,000.
Yeah.
I mean, you were almost there.
Anything going through you gentlemen's your mind right now?
Look, I've seen Tom in person a couple times. I've been on some calls with you and him, Ben. For me, it was a massive aha because I was one of those. Like, I want to do my civic duty, right? Like, I use the roads and my kids go to the schools and I feel like I want to contribute. But once I had that mindset shift that the code is there to incentivize us to go buy a investment property, to own our primary home, to save for our, the health savings. Like, once you understand why the tax code is there, like, the guilt that I used to have in trying to figure out is gone. So for me, the biggest aha out of this is I don't have to feel guilty paying less taxes.
Bob wants to choose what charity he supports when he gives his money away. Chad, anything that's sticking in your mind?
Yeah, Ben, I'm going to give you a Southern answer to this one, right? That makes me happier than collard greens and grits.
You're so stupid.
I know. And I don't like grits all that much either. But I'm living in the South now, right?
You are.
Have
you ever tried collard greens?
Yeah, those
they're bitter. They're not good.
That's okay. Grits, I can't
Grits
handle
are good
the
because
no,
they put
I can't handle
shrimp
the
with
texture of those. Well, then I just want the shrimp. I'll just pick the shrimp out of it, right? Isn't that the point? Now we're talking about food again, and we shouldn't be there. This is amazing how everybody's out there complaining about paying their taxes, complaining about how much money we're giving to the government, complaining on this. And you just did a stupid, simple exercise. And I know it was a stupid, simple exercise we did, but you literally just took someone who made $113,000 and put them into a position of paying $2,000 in taxes.
Yep.
I don't know. Here's what I think. Like, what do you say to change your tax, change your facts? Like, basically people are saying to themselves or okay with, I don't want to go learn this. I don't want to educate myself. You're paying kind of I don't want to call it the stupid tax, Ben, but the difference.
You can call it the Chad
tax. It's the dumb tax. The difference between paying $17,400 and $2,500 is the dumb tax, right? It's just, I have failed to educate myself. Now, whether you made all those, those purchases or those things, it doesn't, if you don't know how this works, you are going to pay the dumb tax.
I am so excited because at the time of this recording, I have not yet filed my 2022 taxes, right? But the audience knows. I got a truck. I moved across the country, and it was my business that needed to make the move happen. I can't wait to sit down and see how low we can get that number with all of the things that we're going to be able to deduct from the lessons we're learning right here.
And even though the year's over, you can still right now contribute to your retirement account for last year.
Right. So when I look at those numbers, I can still come up with the $7,500 to throw into last year's IRA because until April 15th, I believe you have the opportunity to still make a payment to last year's.
When I hear the rhetoric of, Amazon pays no taxes or Tesla pays no taxes, when you hear about Warren Buffett paying, less taxes, it's because they don't sell their assets. You end up paying taxes when you sell your assets. But at the end of the day, Amazon pays an enormous amount of taxes. They pay employment taxes. They pay sales tax. They pay tax on everything they buy. They pay, local tax. They pay real estate tax. They contribute a lot to the world. And the bigger the businesses get, the more they get to contribute. They may not come in the federal income tax line, but they're still contributing a lot to the world.
But not like when I hear that one on Amazon, I'm like, they employ 1 million people that all pay income tax, right? Like, they contribute plenty of income tax.
So I hope today was an eye-opening part of the Wealth Series, and that you think about how can you choose where are you going to donate your money next year. And if you don't want to donate to the IRS and you don't want to do these tax strategies, just donate it to Bob, Chad, and myself, and we'll do something fun with it.
That's right. Send it to the Win, Make, Give charity. We will set one up really quickly and give you the link. It'll be in the Facebook group, Ben, which is Win, Make, Give.
It's called the Jordan Shoe Fund.
No.
The
Yes, it is.
Marathon, Triathlon, Crazy Workout Fund for Chad, and the Parts for an Old Broken Down Mustang Fund.
But not a 1950s
I was going to say, is that a
Mustang.
1950 Mustang, Ben Kinney?
And new guitar for Dave in the back.
For Dave, yes, because he deserves that new guitar. We know it. Folks, come into the Facebook group, Win, Make, Give, where we continue the discussions. Look, we're laughing. We attempt to entertain you while we're sharing this information, yet this is really serious. and valuable information. So who is it that you should be sharing this with? Who needs this episode? Look, we might be getting near the end of the wealth series. That doesn't mean the information just all of a sudden isn't valuable anymore. So share it. Make sure you subscribe to the Win, Make, Give podcast, because when the wealth series is done, we aren't. We are so much more. We are health, wealth, leadership, and legacy here at Win, Make, Give. And until our next episode, as always, do good.